Okay, hello. Welcome back to my channel. I'm Jackie Baker. I'm a real estate agent here in Bergen County, New Jersey. And welcome to my live stream. I am here every week, every Tuesday night at 8 o'clock. So if you're new here, welcome. Thank you so much for being here. I'm so excited. I have a special guest tonight. And I am talking with a good friend of mine, Bob Wilderotter of Homebridge Financial. He's going to be sharing some information about the whole mortgage world, about interest rates and what different loan products are out there. So if you're interested in buying a home, if you're going to be selling and then buying a home, this is a really good one to watch tonight because Bob's going to be talking to you all about the mortgages. So if you have any questions, any comments, let me pull up my screen here. If you have any questions, comments, be sure to drop a comment on YouTube. Also, I am broadcasting to my Facebook page, business page. I'll be monitoring that as well. So any questions, feel free to throw them in there. You have anything for Bob, just drop a question. Okay, so let me bring Bob in. Here we go. Hi.
Hey, Jackie, can you hear me okay?
How are you? Good. I can hear you. Yay. Thanks for
Great.
coming.
Yeah, my pleasure. Thank you.
This is awesome. So, all right, this is good stuff. So I thought it would be a good idea to have you on this week to talk about all the stuff going on out there in the mortgage world. The biggest question right now I'm getting from people is the whole interest rates. You know, they went up a little bit last week. I think they went back down again. But it's the big thing the buyers are freaking out about. So what are you seeing these days?
Yeah, the rates had hit an interim high. So the 10-year Treasury bill, which is a barometer for interest rates, long-term interest rates, had pushed up to 1.7%. And once it hit that level, they came crashing back down. I guess that was the time to take profits. And so the rates, the 10-year Treasury bill is now in the 150 range, 1.5.
Okay.
So the trend is still going to be upward. There are inflation pressures. The Fed is trying to exit the stage little by little. They're the ones buying mortgage-backed securities. That's what keeps rates so low. So as they buy, they have the appetite for the mortgage-backed securities. As long as they keep buying, rates stay low. When they back away, they sort of let the markets handle it. And if they see that it's not going very well, not well received by the markets, they jump in and buy more mortgage-backed securities to try to keep those rates from taking off.
Right. Okay. So are they still predicting the rates are going to be, I know we had discussed this, probably as high as what, 3.5? I remember a year ago, maybe a little bit longer, they were saying they were going to go as high as 4. I mean, are we ever going to see that high of a rate?
I don't know if they're going to go that high. I would think that they'll touch on 3.5, maybe 3.75. But once they get to a certain level, the way the globe behaves, there's always one crisis or another that tends to push capital back to the U.S., which inevitably brings our rates down. So we respond, in essence, by as soon as we get to be sort of a frothy market for interest rate yields and people are desperate for yields around the world, they start buying mortgage-backed securities or treasury bills, which inevitably brings them back down again. So it's sort of a virtuous cycle that really keeps rates from rocketing much higher. So we keep hearing threats of the 4s, and I've heard that for the last 2 or 3 years. COVID, obviously had a big impact on that, and there's going to be a big hangover from COVID. When people file their tax returns for 2020, which has just been done, and we see what sort of damage has occurred to certain businesses. Other businesses made out with profits they've never seen before. So depending upon what industry you're in, you did extremely well. COVID was very good to you, or it was devastating. There's very little middle ground.
Yeah. Right. Okay. So what would you say to people today then who are thinking about buying a house or say, I'm going to wait until the spring? I mean, you think it's still safe enough, that these rates are probably going to be at 3.5, or I know it's hard to predict, but.
Well,
based on your
it's two
experience?
things is the, the waiting hurts you in that, take someone 18 months ago, said, oh, it's too high, I'm going to wait. And they want to save a little more money. So maybe they save $10,000 or $20,000 over the course of, 12 months. Meanwhile, the house that was, say, 400 or 500,000 went up by 20 or $30,000. So you're basically chasing something that's much faster than you can save. So if you're very determined about buying a house or feel that's something that's in the cards within the next 6 months to a year, you should really be out there looking now. I would say there's not going to be a decline in prices. If anything, maybe you'll get a decline in the rate of growth. And the only thing that can really do that is two things: is higher interest rates, which I think even if they go high, they tend to drop back down very quickly, and a sustained stock market crash, for a 2 or 3 year period of time, which wipes out a lot of that wealth effect.
Right.
Those are the two factors that I think would cause that dip or the alleged balloon to pop. I just don't see that happening. The buyers that we're dealing with since the great implosion, they are the best qualified buyers we've ever had. The gauntlet of conditions and guidelines and rules that are in place as lenders, what buyers and borrowers have to go through, it is an audit. I can't explain it any other anymore.
Right.
It's an audit. You have to disprove every negative. You're guilty until we say you're not guilty.
Right.
And so they are very well qualified. There's not speculators in there. There's not some sort of the music stops playing and then we realize there's not enough chairs and then the market crashes. It's simply very good buyers with not enough inventory.
Right. Well, it's funny you say that it's an audit because I had some clients this past year who you were working with, and they were like, why do they need all this information? I just gave him this. I just gave him that. I'm like, well, because that's how it is now. You just, we've learned from the crash before. This is why we're so strict now with all these rules, and they need all this information. So I know it's stressful, for these people that have to come up with all this information, but you're right. These are really solid buyers now because you're digging so deep into their financials. So
well,
I appreciate it.
Ultimately, all these loans lead to the government. So
Right.
practically every mortgage that's written is inevitably bought as a mortgage-backed security by the government, either Fannie Mae or Freddie Mac, which are owned by the government, and FHA, VA, USDA, which are part of government agencies. So they set the template. They're the rule writer. And as a lender, whether you're a bank or a mortgage lender like we are, even though we service, we have to represent and warranty that we've provided all their guideline materials that they needed, checked every box there is. There's no defects in the loan. If there is a defect and it's substantial, meaning the loan's not saleable, it gets bought back by lenders like ourselves or by the banks, and it just goes into a sort of a rotten portfolio that really, if it's going to be sold off, it's going to be at a deep discount. And if the loan does not perform, then it's a total write-off. So you do enough of those mistakes, you're out of business, no matter how big you are. And
Right.
so we have laws to follow and guidelines and acceptable documentation, which quite often leads to more questions. Probably the most difficult part of my job is chasing the assets, the money that people are gathering to bring to the transaction. So they may have, a checking account here and there. They didn't mention they had a retirement account or a brokerage account somewhere else. And suddenly all this money appears. I have to get statements on those accounts. And then if I see large deposits in those accounts, it goes further down the rabbit hole. So that, is probably the most difficult part of it, is just chasing the money so that it's all seasoned for the last 60 days. It sits still and we can represent that it meets the Patriot Act guidelines, that we're not lending to narco terrorists that are trying to launder money to go buy houses and live next door to us. Yeah.
Right. Well, yeah, because that happens all the time, right? So we got to make sure it's not happening. But
Yeah.
so talking about all these guidelines, I just wanted to ask you quickly regarding the appraisal situations. As we know this year, and I've talked about this on several of my videos, where with people waiving the appraisal, it's like, oh, I'm going way over ask. I don't care about the appraisal. We'll cover the gap. But the one thing that I've seen you do with a couple of my clients now, it's the appraisal waiver certificate. So,
Yeah.
and I even had another buyer who was working with a different lender had the same thing. So can you explain that a little bit about how that works? Because I
Sure.
just, yeah.
It's Fannie Mae and Freddie Mac, which are conventional lenders, not FHA, which are government lenders. Fannie Mae and Freddie Mac have a PIW, which is a property inspection waiver. And when we run the property address, once a client has a contract, we put the property address into the equation. We run the computer analysis as to whether it's approved or not. It also tells us, based upon what they know about the property, the street, and if that property changed hands in the last several years, predictively, it'll tell us that, we have enough data points on this home. We don't need an appraisal. So that's typically larger down payments. By that, I mean 20% down or more.
Mm-hmm.
And that saves our clients anywhere from $500 to $700, perhaps more.
Yep.
It's typically for single family properties only, and occasionally for condominiums, but mostly it's single family homes.
Okay.
Not
Now,
2 to 4 family properties.
have you ever had anybody come back and say, I want an appraisal done anyway?
Yes.
Yeah.
Yes.
Okay. Yeah.
And my response is, careful what you wish for. So if the computer says it's good, my advice is you take that and run with it.
Right.
The fact that you're going to spend an extra $500 or $600 just to have this report, which is good for about 90 days. But the appraiser is also going to have to go in there and inspect. Now, you may be okay with the condition of the property. If you've done a home inspection, they're the ones that are digging around looking for problems.
Mm-hmm.
The appraisers, on the other hand, are just trying to do measurements and make sure there's no obvious damage. However, if they find something or question something, now we have to address it. Then they have to come back.
Right.
Peeling paint, missing railing, explain this water stain in the ceiling that may have been fixed 3 or 4 years ago. They just didn't get around to painting it. It's in the basement. I had one client where they built a man cave in their garage, and it didn't comply with zoning, and the guy was not willing to get a CO revised or permits in there. So we ended up not closing. It was a refinance, but he didn't want to, he didn't want to reveal that he did that work and possibly have his taxes go up. So
Mm-hmm. No, yeah.
it made it unlendable. But I warned my client. I said, listen, you're asking for a little bit of trouble. Take a gift horse in the mouth. If they don't want an appraisal report, just run with it.
Mm-hmm.
And it's more efficient. It's one less thing that can go wrong, and less bad things will happen to you.
Right. No, I think it's great. I thank God for that, especially in this market.
More. The appraiser class, these appraisers are on average, 60 to 70 years old. There's not a wave of appraisers coming online to take over this role. They keep it to themselves. It's a craft that they've learned and spent many, many hours and years as apprentices and getting their designations. They're not welcoming new people into the fold. So they are aging out, and they are busy, and they like to keep their themselves limited supply so they can set the market.
Okay. That's interesting.
Yeah.
That's really interesting.
Yeah.
Okay.
Not many kids coming out of high school or college saying, I can't wait to be an appraiser, top on their rent.
Why?
Well,
I don't get that. Why not?
If there's any appraisers online here, my big joke is, they're realtors without the personalities. They're just all about yeah.
Oh, great.
Yeah. They'll go there, look at you, and they just have a poker face and will not even, give you a clue as to whether they thought the value was met or not, or problems. They just want to get out of there, not have a discussion. And then we see the report. Yeah. And
right.
get our little surprises at that point in time.
Well, maybe if they make it look a little more attractive, I don't know, make it more fun job. I don't know. How do you make an appraisal job fun? I don't know, but
Well,
you
they have a
can't.
lot of work to do, so they can't be chatty. There's probably
Yeah.
one guy I know that's a chatty Cathy, and he'll hang around and talk a while, but he's the slowest one to get his reports back. But
Yeah. Yep.
nevertheless, does a good job anyway. So
Yep.
and he's very tries to be very uh, cognizant of what we're trying to accomplish. But
Right.
I don't know if everyone knows this or not, but we have to go through appraisal management companies now in order to order our appraisals. We don't go directly to the appraisers anymore. It goes to a third party company, and there's probably, I don't know, 20, 30 of them, 40, 50, and they put together their panel of appraisers with our consent. And so, for example, in northern New Jersey, where we are, we made sure that we selected appraisers. There has to be like a daisy wheel of at least 10 appraisers available in every market where if they can. And so we try to make sure the clunkers aren't in there that are the difficult people to work with, and the ones that are just, they get their job done and don't create a lot of drama.
Right.
So but once that panel's set, if someone's going to have a bad day again and again, there's nothing I can do about it. I can't go appraisal shop and find someone else. I
Yeah.
can't call them and say, what kind of job did you do here? I have to go to the appraisal management company and plead my case that I've got more comparables here to show that their value came up short or they didn't consider.
Yep. Well, you and I have been down that road before
Yeah.
this past year where we had that happen, but thank God you got it fixed. So.
But sometimes the appraisal management companies, we have a chief appraiser at our firm, so they will sometimes say, you know what, this appraiser is not responding to our new comparables. They disappeared. Their numbers aren't justified, lower or higher, et cetera. And we're going to order a new report because it basically went through, the protocols to override a report and get a different appraiser out there. And that's generally if it's a difficult appraisal to do. But that's the exception, not the rule.
Right. Okay. All right, cool. So let's, I just want to get back on the whole interest rate thing again. So I wanted to touch on this about the borrowing power, right? So if, rates increase, what's the rule of thumb? How much borrowing power does somebody lose when the rates go up, right? So
I did a little slide stack. It's not too long. It's maybe 6 slides, but I can show you what that looks like.
Awesome. Thank you. Oh, just want to say a quick hello. Hello, Jen. My friend Jen's on live right now. Thanks for watching. Is it allowing you to share?
Why am I not able to get the slideshow here? Let's see.
Uh-oh.
Should be.
Bear with us, everybody.
No. It worked when I did the here we go. All right. So here's the average interest rate as of last week that was published. 3.31%. That's a 30-year fixed. That's for loan amounts up to, as of last month, $540,000. Now those limits are going to go up. In fact, we're already out with them at $625,000 as the standard conforming conventional balance. There's going to be some more updates coming with higher loan amounts that they're going to do.
You know what, Bob? It's not showing up. I'm sorry.
Oh, it's not?
I don't see it. No.
Darn.
Shoot.
I'm
sorry.
Okay. Fine. I'll just talk about it instead.
Let's just talk about it. Okay, that's fine.
I wrote it. I should be able to talk about it.
Yeah. Okay.
So
no problem. It's all good.
Today's rate I'm using a $400,000 loan as an example.
Mm-hmm.
So today at 3.125%, 3 1/8, the payment per month is $1,714. Now, if I go back in time, that rate was probably 2 5/8. And when I mean back in time, at our all-time lows, which was within the last 12 months.
Mm-hmm.
So that same mortgage amount was 1607. So
Okay.
the payment difference today versus what it was at its all-time low, is $107. And at $4.28 per thousand, that's about a $25,000 value. That means 25,000. You lost about $25,000 of purchase power.
Wow.
With that kind of movement. Now, if today's rate being 3 1/8 went to 4 1/8, that $1,714 payment is now, for the same mortgage amount, now at 4 1/8 is $1,939. And that payment difference, $225 a month.
Right.
Okay. So my purchase power just was diminished by about $52,000.
Oh my God.
So for every 1% move, all things being equal, I lose about $52,000 of purchase power. If I want my payments to stay the same, it doesn't mean I can't afford it. It just means that my budget, for that same loan amount I was going to get for that house in a market that has rates of 4.125 is $225 more per month.
Yep.
Okay. Now, that could also cause the homes to stop appreciating so quickly. Maybe they stall and maybe they back off a little bit.
Mm-hmm.
So you can recapture that. But think of it another way. A town like Mawa with very reasonable taxes compared to a town like Ramsey. So the taxes could easily be $225 a month.
Mm-hmm.
$225 a month difference, right? $225, that's a $2,700 more a month. So let's say the $500,000 house in Ramsey has taxes about $2,700 higher than Mawa. Actually, I think it's higher. I think it's probably $3,500 to $4,000.
Yeah, I would agree with that. Yeah.
Right. So that eats your purchasing power as well.
Yeah.
A lot of clients and buyers, when I'm talking to them, and they're like, wow, I didn't think my payment's gonna be this high. What can I do? What if I put down $10,000 more? And I'll say, well, all right, you could put down $10,000 more. You're only gonna save $41, $42.
Mm-hmm.
I'd rather have the 10 grand at the bank, frankly.
Right.
I said, or you need to buy in a town with cheaper taxes, and that's where your budget's getting blown up, are the property taxes.
All the time.
All the time.
Yep. All the time. That's exactly.
For our 85 school districts here in Bergen County. So.
I know. But I mean, so I'm sure that's like a big thing for you then, when you're talking to people about their budget, that's the key thing. So you tell people, okay, keep the property taxes, like say 15,000 and under, what for houses you're looking at, or right? Am I right in saying that?
Yeah. And I've been doing this for 40 years, 40 years almost. So I know generally when I ask them where they're looking, I want, a list, tell me what towns you're looking at, and they'll rattle off 4 or 5 towns. So I know the taxes generally in all the towns, if it's Northern New Jersey versus Central or Southern, if it's Rockland or Orange County, I know what we're dealing with. If it's the boroughs, I know the property taxes are pretty cheap. But so I generally can guesstimate what I think the taxes will be. I'm usually within about $2,000 of that, and I'll always tend to try to overestimate by $2,000 or $3,000, and then then we put it to reality, and everyone's pleasantly surprised.
Okay.
And frankly, Jackie, it's not so much the affordability of the house that our clients struggle with. There's another half of the equation, which, what is your other debt? So because mortgage money is the cheapest money you're ever going to get, short of having rich parents, right?
Yep.
So if you're paying, $4 and 15 cents a month per thousand per month, $10,000 is $42. 100,000 is $420, and a million is $4,200. If you just use that multiplier effect, so it's cheap money. It doesn't get any cheaper when you stretch it out over 30 years. But there's student loans as an example, and we talked about this earlier. I'm looking at people's credit reports, and I see student loans in deferral, forbearance, and so forth, or they're making the minimum payments only. This is really important because these student loans are negatively amortizing. If you understand that whole concept, it means you're choosing to make a lower payment like a credit card lets you, and you're not paying the full amount. So what happens that the amount you didn't pay gets added to the back end of the loan. So I'll see someone that's like in their 30s that borrowed, originally $60,000. Now they owe $85,000, but they're current on their student loan debt. It's never going away.
Right.
So that's a frightening thing. And, when I do talk to new home buyers, I say, you know what, right now, because of COVID, there's a forbearance out there. No one's being charged interest on their student loans right now. I think that ends January. My suggestion would be to double down and don't worry about saving more money for the down payment for the house, because we can do mortgages with 3 and 5% down. That's not the problem. It's your other debt. So take that extra few $100 a month and just drive down those loans one at a time. Just attack them, and make them go away.
Right.
So that's my suggestion for them to do that.
Yeah, it's amazing how these student loans can just balloon like that, and next thing you know, oh my God, they're paying so much more in money because of the interest.
Yeah.
I mean, it's unbelievable. Like, holy crap! It really bothers me. I get upset for my clients. I have all this student loan debt. I'm like, oh my God,
there's no escape. There's no escape from student loan debt. Not bankruptcy, not even death. Okay, so the state is responsible for those loans. If your parents co-signed, they're going after the parents.
Unbelievable.
Yeah,
unbelievable.
So, those are while you're at before you're buying a house in your early 20s, just have my suggestion to the kids that are just out of college. Don't take the cheapest payment option out there. Just start amortizing that loan. Try to pay it out within a 10-year time frame. Make it go away.
Just
consolidate them. Some of the student loans are absolutely terrible rates, but once you have a job, I noticed that you could the college grads with jobs can get those rates cut in half. From 7, 8, 9% student loans, they could get them down to 3, 4, 5%.
Oh wow! That's good.
Yeah. So I'll look at that to, consolidate your student loans and let's get those payments lower. Now you can afford more house. Other things I'll do is look at their credit scores. If you have credit cards out of balance, meaning, you're past 70% of available credit, you could have zeros on 5 credit cards, nothing used, only $1 out of 1,000, but one card's over the max, and that could drive down your credit score 30, 40, 50 points by doing that. So at that moment in time, that's the snapshot of your credit. And so we have the ability to do an analyzer, say, hey, if you rebalance your credit cards, pay, this down, that down, the other down, you will get a score improvement of 20, 30, 40 points. I just had to do this for a client. They had a charge off. It's just one of those bills that slipped past them. And they were able to show that they paid it off. It brought them from a 580 credit score up to over 620. That was the difference between having to get an FHA loan with mortgage insurance and everything, even though they're putting down 40%, and conventional got them a good 3 3/8 rate, 30-year fix. So they're happy as can be, and we got them what they wanted by doing that.
Right.
Late payments, I can't help you. That's the only time can fix that, but credit cards that are overused can be fixed relatively easily. And that's also, I may take some of that down payment money and suggest they pay down these credit cards to get a better credit score and a better outcome with rates.
Okay. Yeah, I mean, it's just I'm glad you brought that up because a lot of people don't take into account their debt. They figure,
Yeah,
oh, or if they
Carly.
think they have a good credit score, they think they do, but they
Yeah.
they don't.
Well, you know what?
I get that a lot too.
People
So
have, yeah, they don't play their cards very well. I mean, every time I talk to someone, they're like, I'll ask, when they self-rate, how's your credit? And if it's excellent, they tell me it's excellent. I'm 800. I'm 802. They know, they're like braggy about
yep,
how they track their credit. And you know what? They're right. That's always the case.
yeah,
Others are like, I don't know. I get that sort of
yeah.
hesitation.
When you hear that,
It's going to be below 700. And the other's like, yeah, we got a problem. Then sorry,
right?
let's run the credit. Let's see if we can fix it and get you lendable on your way. So there's a solution for everybody. If it's not now, it's over time. We can get virtually everybody lendable.
Good.
Yeah.
Okay, I do have a question from Steve. He wanted to know, are people taking smaller loans and putting more cash into a house because of the higher standard tax deduction and people not able to itemize their tax deductions? Does that make sense?
Well, the deductibility, I think, for couples is $750,000 mortgage, and for single,
Okay.
it's $350,000. So I'm not seeing people back off on the mortgage amounts, other than sometimes the number just simply frightens them. That I can't believe I'm borrowing $600,000 or $700,000. I never thought I'd be borrowing that. My parents think I'm crazy, but everything's relative. If a couple of buyers, are making 250, it's not that hard to do in this job market at times. They
Mhm.
can afford $1 million mortgage. It's all about monthly ins and outs.
Yes.
And,
True.
and to reply to this is going to be a controversial statement. So let's make sure that I'm not on Fox News after this. But I had attended a workshop with an economist and a like an appraiser, like consultant. He's like kind of the Jeffrey Ottow. You probably heard of him. He has a
Oh
news.
yeah, yeah,
Yeah.
yeah, oh, yeah.
So there was a workshop that was, that he did a fabulous job when Trump's tax plan came out. And essentially what happened is they dropped all the brackets. So all the top brackets were lowered by 3 or 4 or 5%. And then they got rid of the alternative minimum tax. And then they gave standard deductions of $12,000 per person. So that's 24,000. And Jersey and New York got the SALT, state and local tax deduction, up to 10 grand. So all that combined, like a married couple with paying taxes over 10,000, which isn't hard to do around here, already out of the gate, I have $32,000 in write-offs. My first $32,000 of income is not taxed for federal purposes. So
Right.
there's where we made out. 85% of the population in the blue states made out better. They think they got hosed. They didn't get hosed. Okay. The ones making more than $500,000, okay, they paid more a little bit. But generally speaking, the optics of it, they think that the SALT, state and local tax, yeah, you got a bigger deduction, but on a higher rate of taxes. Now you got a lower rate of taxes and a smaller deduction. You still made out better. And that's the big lie I keep seeing peddled out there all the time.
But I got to tell you, I agree with that statement because I think that was the first year in a long time that we actually got money back on our taxes when that came into play. Yep. No, I agree with you.
Yeah.
So we'll
but
both.
you can't convince people that their minds are made up. It's like, there's no way that's possible. I think where they didn't get back as big a refund because their payroll taxes were offset by the lower tax rates. So their refunds may have dropped, and they're complaining to their accountant saying, hey, how come my refund was smaller? The accountant pulls out their W-2. Look how much they took out of your paycheck versus what you paid. You paid less in taxes. It's just you were used to a bigger refund. But here, like, they had all the ADP and paychecks and all them had adjusted the schedules so that there wasn't an enormous amount of money owed. They gave people more take-home pay, so they had it year round. And so once they understood that, they realized, like, oh, I really did get a tax cut.
Yeah.
So, it's just.
Yeah, it takes a bit to make you see it. Yeah.
Yeah, for sure.
Um, anyway, all right. So let's get into some of the programs, loans that are out there. So, like, what's for first time buyers right now? Like, what's popular? I mean, do you have any first time buyer programs, or it's just strictly you either FHA or conventional loans?
Yeah, so the conventional loans will go with as little as 3% down. So there is an income limit on that. I think it's around 90,000 for a couple. So it's starting to push past that usefulness because people make too much and then they don't qualify for that 3% down product. Exactly. That product has less price hits if you qualify for it, and the PMI, which is private mortgage insurance, is more favorable for that product. So they're getting a cheaper rate. But
Mhm.
up to now, it's going to be 625,000. You can put down 3%, and then 5% down currently with a loan amount up to $822,000 in northern New Jersey, lower New York. So, you know, that's what's out there. Besides which, there's the firefighter police program, which we do offer. It's a very sort of niche product. It's a very long process to do. It has to go through several underwrites. In this environment where the sellers are selecting the safest and highest offers with larger down payments, those loans are just sort of just getting slid right off the table. They're not
Yeah.
dealing with low down payment. I have a
Yep.
hard time with VA veterans that want to do the 100% financing, and
Yep.
sellers are afraid to deal with that. They don't have skin in the game, and what the VA, they think the appraisers are going to wreck the whole process. But FHA will let you borrow up to 822,000 with 3.5% down payment, and conventional. So that's what's out there. It's just low down payment loans. When you
Yep.
go into the inner city areas, certain zip codes, they'll remove the maximum incomes, and there's other goodies in there. Certain cities have down payment assistance programs, which generally banks that are chartered in New Jersey or New York, wherever they happen to be, are going to have some goodies to give away to try to prove that they're worthy of having bank charters. So there's basically a money pot that they use to help in these targeted cities, and it works nicely. It helps come up with that, but it's not really workable in the suburbs.
All right. Okay. So we were talking about this yesterday. So there are also some options for people who say don't like have income, but they've inherited money or they've gotten like alimony or whatever, and they're going to use that to
Yes.
put towards a house. So let's talk about that a little bit. How does that work?
Okay. So as a lot of the best buyers out there, large down payments, both working couples, nothing to sell. They've kind of cleaned up and gotten their properties. There's still a lot of them out there, but there's a second and third wave of buyers out there that want to get in on the game. Now, there are rules about lending that say you can't offer these no doc loans anymore, right? The no doc loans got us in a lot of trouble. They changed lending as we know it today. It was no income, no asset check, poor credit, negative amortization, prepayment penalties, higher rates, higher default rates. So these loans were basically no questions asked mortgages that enabled people to buy 2, 3, 4, 5 properties at a time and kept trying to ride the wave of inflation and just keep flipping and flipping until the music stopped. And then they were left with unsustainable payments, with tenants that couldn't pay. And it caused a whole cacophony of the industry to collapse. And, there's still a ripple effect of those devastating days for many buyers to this day. So putting that to the side, Dodd-Frank came out there and changed the rules. And they also said, I don't care what you come up with, but you must show an ability to repay, the ATR rule, that you need to show there's a reasonableness that someone is able to make payments, even though they don't meet the criteria of what Fannie Mae, Freddie Mac, FHA says. So they write the playbook on what government will buy, which is a huge component of the market, but there's another class of buyer out there that can't check all those boxes, but are also very good credit risk. So what's out there, I'll name 4 different type of products that exist. So for self-employed, for example, if their tax returns, are too complicated, then what we could do is use the last 12 or 24 months business checking account to look at their cash flow and determine an income from the ins and outs of their daily activities from their business. So that's like a light doc where we see that they're ringing the register, that they're taking an income out for themselves, that they're profitable every month. That's an ideal candidate that can go ahead and buy with 20% down payment or higher. The rate they pay is maybe 0.5% higher than what might normally be gotten. Very safe loans. We still expect very good credit scores from those folks. So that's ideal for self-employed. The other one you had mentioned is clients that were recently divorced and have come into a lot of money. They inherited a lot of money. They sold their business. So let's say a plumbing supply store sold out for $3 or $4 million, but the caveat is that he no longer works there. So they want to go buy a shore house but the old rules say, well, you don't have a job anymore, so you can't make the payments. So they look at the amount of assets in the bank or a brokerage account, and if you just peel it off, over a 30-year time frame, and there's still money left, they get a mortgage. It works.
Mm-hmm.
That's another one we do. Then there's those that want to buy homes and rent them, but have very difficult financials, that would maybe not get through the gauntlet very easily. We just look at the cash flow of the property versus the payments of the loan. And as long as the rent covers 100% of the expenses, it's eligible for financing without having to see their tax returns. It's great for, for people that want to own a lot of properties, and they tend to have a lot of repairs. They buy a house, fix it up, it's empty for 3 or 4 months. So whenever I look at a tax return, I've got, perhaps they have 10 properties. The first 8 are profitable, but the last 2 they got are devastating to the tax return because they were empty. They had to fix them up, and that's where they basically experience most of the losses till they get them up and profitable. We don't worry about that.
Okay.
And then there's a 1099. So realtors, insurance people, IT professionals are contract employees. So they also get to expense down their income. Rather than look at their tax returns, we'll look at their 1099. We take 25% off the top. If that still works, they can get a loan as well. So they're paying a little bit more as a result of lighter documentation. But in the end, they're successful finding a home. And these are called non-qualified mortgages, meaning they don't meet the criteria of being sold to the government.
Okay.
We're one of the few lenders that offer this.
Okay. Oh, very cool.
Yeah, so you have to have very well trained underwriters that know how to apply these guidelines that are unique to these products. You can't just jump in and do it out of the blue.
Yeah, I mean, I've always been happy with your services, what you guys have done for my clients. We got a question. This is from Ryan. Hi, Ryan. Thanks for joining us tonight. So Ryan's question is, I'm planning to sell my house in Hudson County and would really want to move to Leonia, Palisades Park, Fort Lee. Do you think I can get a new mortgage right away after selling my house?
A lot of people are afraid to sell their house before they have another house to buy. So if you're talking about you have a place to live after you sell your home and then want to go out and look, yeah, there should be no problem at all. That's the easiest way to do it and would render you the most successful flight path to do that because there's no condition of you selling your home in order to buy the next home. But what most people are experiencing that own homes already is they have most of the down payment money tied up in the sale of the other house that hasn't happened yet. So they're looking for that bridge loan thing in order to make it enable them to go from one house to the other. And where do they get those resources from? So there's several ways I can help them find the resources for the initial 5 or 10% deposit. and then for the remaining down payment monies before they've sold the other house. And that's through a combination. I would recommend, for example, getting a home equity line of credit. Before you put that house up for sale, go for a line of credit, try to get 100,000 or 250. It takes about 5 or 6 weeks these days, and a lot less banks are doing these. We're rolling out these type of products in the next 30 days, by the way. We're already piloting them, and we're going to have quite a lot of choices on what to do. But for now, let's just say, go to banks that are still doing home equity lines. They're dirt cheap to get. The closing costs are like a couple $100. You can get interest-only payments on these things, and you only use the money when you need it. So if I get approved for $200,000 line of credit, and I already have a $200,000 mortgage on the house, and the house is worth, say, $600, I can pull $250 or $200 out of that house to use for the down payment for the next house. And now I've got resources to put a place marker on the house that I want to buy. I may have to carry 3 mortgages at once, which might appear frightening at first. So what if I have to carry 3 mortgages on 2 houses? Is not exactly an enthusiastic thing that a client looks forward to, but they may sell simultaneous, meaning, the market's so hot, I could find this house, I have a contract, I'm going to close December 30th. And then once I've got that house secured, I could find a buyer that's perhaps a cash buyer or someone that's already done the pre-approval process and can close and line up with me same day, and it's all solved. Quite often they can overlap for a couple of weeks, and that's not a big deal because your first mortgage payment on a new home won't be for like another month and a half anyway. But other places I'll suggest they go look are their 401ks. You can borrow up to $50,000, up to half the value of your 401k account. And they'll give you terms of up to 15 years typically to buy a house. You can tap into an IRA. You have 60 days to replace that. So if you use that as your own bridge loan to yourself, as long as you're confident your other house is going to sell in time to pay yourself back, avoid the tax consequences, that's the way to go. You could take a bigger mortgage on the house you're buying. And then when you get the proceeds of the other house, will allow you to modify the payment and bring the loan down to what you wanted it to be with payments of what you wanted to end up with. So it's a conversation that I have with clients, and it's not one size fits all. It's probably a combination of what I've just talked about that comes out the simplest outcome, so that we have a good operating plan and they feel confident about going out to buy the next home.
Right.
Yeah, that makes sense. So with Ryan, may not want to sell the house out from under him, may have no place to go. Yeah. And so that's a big fear. So this is a way you can try to do 2 things at once and line them up optimally so you can accomplish what you set out to do.
Right. Okay. Ryan said, thank you guys for answering. Been following your channel. Ryan, thank you so much. I really appreciate that. Thanks for coming on. And if you ever need anything else, reach out again. We're happy to help you. So are you finding this a lot now? Because this has been the biggest issue for me and my clients, those who need to sell and then they're trading up, they have to buy, but then they have that money locked in. They don't have the money to put down because it's coming out of the proceeds of their sale. So are you finding this a lot? People are doing the HELOCs or the borrowing on their 401k to cover that down payment on the next house?
Yeah, or they're taking a bigger mortgage. Sometimes it's too late. They've already listed the house, and you can't easily get a home equity line on a house already. Right. Because think of the bank's point of view that's doing the home equity line. It takes several $1,000s of human resources to get a loan on the books. So if you're just going to pay it off like a few weeks later, it's a money loser for them. So they're not going to be too keen on doing that, or they're afraid that what if you're going to skip town, or what if you're going down with the ship, sort of thing. So it's better to do it before you put the house up for sale. So if that conversation's happened early enough, that's my first suggestion. Okay. After that, we'll be offering, like, we could put a second mortgage on the house you're buying. So which be like a throwaway mortgage. Okay. So let's say you want to end up with a $400,000 mortgage. You can only come up with $100,000 on your own, and you're going to clear $100,000 from the other sale of the house. I put a second mortgage simultaneous on the subject property you're buying, And once they've sold the other house, they just pay that loan off to zero, and they're left with the first mortgage that they
Okay.
intended. And then the final way to do that is just take that windfall cash and contact your servicer and ask for some paperwork to get the loan rejiggered based upon the much lower principal. And they'll charge a couple $100 to do that, but then your payments are recast based upon the lower principal at the rate you closed at without having to refinance.
Okay. Okay. All right. So, I mean, it's good to know that there are options that, people can get through that transition period of, selling the house, having the money ready to put down on the next one. Because, I mean, as you and I have seen this past year, how hard it is for my buyers to get a house without having 20% down. I mean, the competitiveness has just been insane. It's, it's just how it's been this year. But I think that's been the biggest issue where people are freaking out. Like, I don't have the full 20%, but these are good options. So if somebody could start that process now of getting a line of credit, if they're not going to be buying a house for, say, a few months, and that might be worth their while. But, I have to ask you this. Why are they stopping all these? A lot of the banks aren't doing the lines of credit anymore.
When
What happened there?
COVID hit and there was a forbearance contagion. So remember, like it almost put the mortgage business completely on their backs. It was very frightening because essentially when you service loans, and we service about $30 billion of mortgages. We're expected to deliver those payments whether we get them or not. So suddenly 10% of the mortgage holding population has this get out of jail free card, and they're able to go into forbearance. The bondholders, the people that have bought that yield, expect to be paid. If you're going to be a servicer or a bank that services loans, that's your representation, that you have the capital to forward those payments, whether you got them received or not. So, imagine that the scale of how that happens, and so the law wrote that forbearance, which is good. It helped a lot of people. Too many people used it. They just sort of hit the panic button. They were just curious. And next thing you know, they're in forbearance and they're calling me to refinance these new little rates. I'm like, you're not making your mortgage payment. Why would you expect to get a lower rate if you're not making your payment now?
Yeah.
You're considered. So that created a bit of a mess. So basically Wells Fargo, Bank of America, Chase ran for the hills. They basically just disbanded their home equity loan departments. They rolled back whatever criteria they were offering, and it sort of left it to the mid-sized banks that are still out there that are looking for new client bases. Some credit unions, as an example, will do that too. But it probably dropped the participating bank population in half that were willing to do that. And so that forbearance ability that no good deed goes unpunished, inevitably it frightened away a lot of the banks, and it tightened up lending rules. And we're still in COVID mode with how we underwrite, which is really, really a pain in the neck, I gotta say. What we have to look at, the last steps before closing. I have to talk, not me, but my prosecutor, have to talk to the immediate supervisor. It can't be a robot anymore. We need a live person.
Yeah.
Verify that COVID has not affected your ability to work, that you're still in business, you're still there working. Because people were getting furloughed right at closing, right before closing.
Remember that? We had that last year.
Yeah.
We had that happen to one of my people who fortunately ended up buying this year. But yeah.
That's right. Yeah.
I totally could see that. Yep.
Yep. One was a hairdresser I was working with. They shut the salon down because of COVID. And we were like, her father-in-law, stepfather came in and asked to co-sign. I was just running documents left and right with mask on, and we got it done. But, we're sort of coming to grips with what was happening with COVID. That was like the first casualty. We still got it closed, but, who you're talking about, he lost his job. He was done.
I know he was. Yeah. Yeah. I mean, that was terrible. But thank God it all worked out for him anyway. He ended up getting something else, getting back on his feet.
Who got very affected, which was sort of a shock. They're almost, in my view, recession proof as a class of people. Doctors were crushed. Doctors and dentists.
Really?
They had to close their offices. They couldn't see patients.
Yeah, that's right.
Any of those, knee surgeries, any sort of elective surgeries did not happen. So they were just dead on arrival. So, I had a couple of doctors who dealt with this, and we had to factor in basically the big gaping hole of 3 to 4 months of no income, no revenue. And we had to average it in as they ramp back up again. So it was not easy. And it was really, grueling trying to get them to show that they've rebounded and how they climb out of it.
Yep. Yeah. Well, those were challenging times. So let's hope we don't have to deal with that again.
Yeah. Let's say no COVID 22.
No, don't say that.
Yeah.
Anyway, I think that's all that I had. Is there anything else you want to add, or so I know what your answer is going to be. Is it still a good time to buy? It's probably still a good time to buy, right?
Yeah, it is. Remember, the rates are so low. So we talked about the affordability. They're going to be low, for now. But I think, this spring, and the Fed is stepping away from buying the mortgage-backed securities. They're going to rise. How much, I don't know, but I don't think like to a devastating end, not like to 5 or 6%. But, they could touch on 4%. And I would tell people, you don't have to love the mortgage. You need to love the house. So if the rate's not where you like it, you're trying to time the market. Like, well, I got the perfect rate now. All I need is a house. And then the rate expires. It's gone. Now that house shows up and now it's 1% higher. Do you not buy that house as a result of it? And I would introduce other ways to get that payment lower, like an adjustable rate. Right now, they're out of vogue because the 30-year fixed are so low. But when rates were in the 4.5%, I was talking to clients about taking something fixed for 7 years or 10 years, and the rate was 0.75% cheaper. And then they're like, well, what happens in 7 to 10 years? I'm like, my average loan stays on the books less than 5 years. I mean, as an industry, loans don't last more. And when COVID hit and rates really hit rock bottom, they refinanced again for another 0.5% cheaper. So that devastated mortgage-backed securities because you couldn't even get a yield because they were paying off so quickly. So the moral of the story is there's always going to be cycles that are tighter than ever. And whether you take that 4.5 rate or take a 10-1 ARM that's 3.5 or 3.75, either way, you're refinancing in 2, 3, 4 years, whereas you paid a lot less during that waiting period. You then go out to year 7 or 11 and then have to get a rate of like 6 or 7. You have plenty of opportunities to get out of that into a long-term safe rate that would take care of it. So these mortgages are just a tool to get you into the home. Yep. And to get out of these mortgages is very cheap. We're talking, we may not need appraisals. The title insurance is about 1/3 the cost of what it was for a purchase. You don't need a lawyer. You don't need a survey. You don't need a home inspection. You already have your taxes and insurances in place. You're just going to replenish them and get back the refund from the old company. So it's a very efficient business. That's why the rocket mortgages of the world exist out there. And the internet lenders, that's what they make their living on. It's just trying to churn those same mortgages to lower rates, even for 0.25% cheaper, which is silly. But, my policy is that you should be able to recapture your closing costs in 1 year. If you capture it in 1 year or less, it's a home run. 2 years is still a good deal. Going much beyond 2 years, we have to have a conversation as to whether you really plan on staying in that property for 5 years or more. Right. And then we talk about it. The bigger the loan you have, the less downward the rate needs to go to get savings. It's all proportionate. People with $100,000 loan at 6%, they're 13 years in, they want to refinance. And I'm like, it's not worth it. The closing costs, you're pushing out the end of the loan another 10, 15 years, and your payment savings aren't really that great, and your closing costs are so out of proportion, it'll take you 7 years. Yeah. So my suggestion is don't refinance, just pay extra on it every month.
Right.
Not to zero.
Right.
So we look at all that and do an analysis. I'm not in the business to do a loan for a loan's sake. It has to have a tangible benefit to a client, whether they're refinancing, getting out of the adjustable into a fixed, or going from a higher rate fixed to a lower fixed. It has to make sense.
Okay.
Okay.
Yeah, that makes sense. But I like how you say, you don't have to love the rate, you want to love the house, and
Yeah.
just get the house if you love the house. And then, yeah, like you said, it's a tool and you can go back and just get the rate lowered, when you get down to, you know, when the rates do drop again. So
And they
I
will.
love
They
that.
do.
I just love that whole process because people get fixated, as you and I both know, people get fixated on that rate, and it's that you can change. If you miss out on this house that you love, you're not going to get it again, so
Yeah.
that
Yeah.
you can't go back,
Houses
you
and
could,
locations are unique things, especially
yep,
locations. So that
yes,
location may never show up again for 30 years.
exactly.
Rates are rates. And then one last thing I know we're going past, but the cycle of rates going from low to high, high to low used to be, every 2 to 3 years. Now it seems to be every 2 to 3 months. So
Hmm.
as rates start to track up because the Fed's, backing away, some other global, emergency will happen, which will cause money to flock to the U.S., drive down rates, and here we go again with lower
Yep.
rates. So I just don't believe that if there are spikes in rates, they're not going to be very long-lived. They'll
Yep.
go down relatively quickly.
Cool.
90-day cycles.
All right. Well, good to know. So I hope everybody out there is paying attention to this. So.
Thank you, Jackie. All right.
All right, Bob, thank you so much. I'm going to have your contact information down in the description box. So anybody has any questions, I'll have them reach out to you, the email or call you or whatever. Is that cool? We can
That'd
do
be
that.
wonderful. Thank you. I appreciate it.
All right, Bob, thank you so much for being with me tonight. This was such good information, and I'm sure you helped a lot of people and answered
Thank
a lot of
you.
questions.
Yeah, I know we covered a lot of ground. I hope people's heads aren't spinning.
We got a lot. So thank you. I really appreciate it.
You bet. Okay.
All
Thank
right.
you.
Have a good night.
Good night. Bye.
All right. Bye.